Have you ever found yourself holding on to an investment long after it stopped performing well? Or maybe you've noticed yourself eagerly seeking out information that confirms your existing beliefs about the market? If so, you're not alone. Today, we're diving into the fascinating world of mental shortcuts and how they can lead even the savviest investors astray.
It's so true. I feel like I'm constantly falling victim to these mental biases, even though I know I should be more objective. Can you give us a quick overview of the most common investment biases we need to watch out for?
Absolutely. The key biases we'll be exploring today include anchoring bias, confirmation bias, status quo bias, hindsight bias, and control bias. Each of these mental shortcuts can have a profound impact on our investment decisions, often leading us to make irrational choices that deviate from our long-term financial goals. But the good news is, once we understand how these biases work, we can start to develop strategies to overcome them.
Thanks for that great overview of the key biases we'll be discussing today. I think it's important to emphasize that while these mental shortcuts served an important evolutionary purpose, they can really trip us up in the modern investing world. Let's start by diving a bit deeper into anchoring bias. This is our tendency to rely too heavily on that first piece of information we receive about an investment. Can you give us a practical example of how this might play out?
Sure, let's consider a common scenario. Imagine an investor purchases a stock at $100 per share. Even if the company's fundamentals start to deteriorate and the stock price drops to $80, the investor may remain fixated on that original $100 price point. They might think, I'll just wait until it gets back to $100 before selling. But this anchoring to the initial price can prevent them from objectively evaluating the company's true prospects and making rational decisions about when to hold or sell the stock. The $100 price becomes an arbitrary reference point that can lead to suboptimal outcomes.
Wow, that's a powerful example. It's easy to see how our minds can get stuck on that initial number, even when the situation has changed. This actually reminds me of something about sunk costs, our tendency to continue investing in something just because we've already put resources into it, even if it's no longer the best path forward.
Great connection. Anchoring bias and the sunk cost fallacy are definitely related concepts. They both illustrate how our past experiences and information can overly influence our present decisions, even when that past information is no longer relevant.
Exactly. And anchoring bias can show up in other subtle ways too. For example, studies have shown that even completely arbitrary numbers can act as subconscious reference points. In one famous experiment, researchers spun a wheel of fortune in front of participants before asking them to estimate the percentage of African countries in the UN. Those who saw a higher number spun on the wheel tended to give higher estimates, even though the wheel number was obviously unrelated to the question at hand.
That's wild. It really shows the power that initial information can have on our subsequent judgments, however irrational it may be.
It's kind of unsettling to realize how easily influenced we are by these arbitrary reference points. How can we start to overcome anchoring bias in our investing practices? Are there any practical tips or strategies?
One key strategy is to intentionally seek out diverse perspectives and data points. Don't just rely on your initial impressions. Actively look for information that might contradict your stance. This can help you break free of that anchoring effect and evaluate investment opportunities more objectively. It's also helpful to step back and ask yourself, is this initial information truly relevant to my investment decision? What other factors should I be considering? Slowing down and engaging our more analytical System 2 thinking can help counteract the automatic System 1 processes that anchoring bias relies on.
Those are great suggestions. It's all about being proactive in questioning our default assumptions and automatic judgments. And simply being aware of these biases is an important first step. Once we understand how they work, we can start to catch ourselves in the moment and adjust our thinking accordingly. This might be a good time for a quick recap before we move on to the next bias. Could one of you summarize for us the key points about anchoring bias and how to counteract it?
Sure thing. So anchoring bias is our tendency to rely too heavily on the first piece of information we receive about an investment, even if that information is arbitrary or irrelevant. This initial anchor can skew our subsequent judgments and lead to irrational decisions. To overcome anchoring bias, we should intentionally seek out diverse data points, question the relevance of initial information, and slow down to engage our analytical thinking. By being aware of how anchoring works and proactively challenging it, we can make more objective investing choices. How's that? Did I capture the main points?
Perfectly summarized. I like how you hit on both the key characteristics of anchoring bias and the concrete strategies we can use to counteract it. Now, let's build on that foundation and explore another common investing pitfall that's closely related to anchoring: confirmation bias. Let's introduce this concept to our listeners and explain how it connects to what we've discussed so far about mental shortcuts in investing.
Absolutely. Confirmation bias refers to our tendency to seek out and give more weight to information that confirms our pre-existing beliefs, while downplaying or ignoring evidence that contradicts those beliefs. Like anchoring bias, confirmation bias is a mental shortcut that can lead us astray in investing. Once we form an initial opinion about an investment, we may subconsciously gravitate toward data that supports that view and discount information that challenges it. For example, let's say an investor believes that a particular company is poised for growth. They may selectively focus on positive news about the company, like a new product launch or an upbeat earnings report, while glossing over potential red flags, like increasing competition or high debt levels. This skewed information intake can cause the investor to maintain an overly rosy outlook and potentially make misguided decisions.
I can definitely see the connection to anchoring bias. With anchoring, our minds get stuck on that initial piece of information. And then with confirmation bias, we seek out data that reinforces that starting anchor or belief, creating a sort of self-perpetuating cycle. Is that an accurate way to think about the relationship between the two?
That's a great way to put it. Anchoring and confirmation bias can absolutely feed into each other, creating a loop of biased decision-making. The initial anchor sets the stage, and then confirmation bias selectively filters incoming information to support that anchored perspective.
This is such an important point. It's not just that these biases operate in isolation, they can actually compound and reinforce one another. The more we understand about how they interrelate, the better equipped we are to spot and disrupt these patterns in our own thinking. What are some strategies we can use to guard against confirmation bias in investing? How do we ensure we're not just seeking out information that confirms what we already believe?
One key strategy is active open-mindedness. Rather than just looking for information that supports your existing thesis, intentionally seek out countervailing evidence and opinions. Read analyses from those who disagree with your position. Engage in constructive debates with fellow investors. Exposing yourself to a diverse range of perspectives can help reveal blind spots and challenge confirmation bias. It's also important to be aware of the sources you rely on for investment information. Are you drawing from a balanced mix of reputable, quality sources? Or are you gravitating toward outlets that tend to confirm your pre-existing views? Diversifying your information diet can help mitigate the echo chamber effect.
Those are great tips. It sounds like overcoming confirmation bias requires us to actively question our assumptions and default modes of thinking. We have to step outside our comfort zones and grapple with ideas that might challenge or even contradict our beliefs. That reminds me of something we discussed in an earlier session about the value of intellectual humility in investing. Being open to the possibility that our initial take might be incomplete or misguided seems to be an important safeguard against both anchoring and confirmation bias.
I'm so glad you drew that connection. You're absolutely right that intellectual humility is a common thread here. Anchoring, confirmation bias, and many of the other mental shortcuts we've explored can lead us to be overly attached to our own perspective. Cultivating a mindset of openness and humility allows us to more readily question and reevaluate our views in light of new evidence. As we wrap up this segment on confirmation bias, what's one key takeaway you'd offer our listeners?
If there's one thing to remember, it's this: always be willing to prove yourself wrong. Approach your investment thesis with a spirit of inquiry rather than certainty. Seek out disconfirming evidence as eagerly as you seek out confirming evidence, and be open to changing your mind when the weight of data points in a new direction. This isn't easy. Confirmation bias is a stubborn mental shortcut. But by deliberately cultivating habits of open-mindedness, self-questioning, and engagement with diverse perspectives, we can start to weaken its grip and make more clear-eyed investment decisions.
That's a powerful takeaway: the importance of always being willing to prove ourselves wrong. I'm curious, how does this idea connect to another common investing bias, the illusion of control?
That's a great question, and there's definitely a strong link between confirmation bias and the illusion of control. When we're in the grip of confirmation bias, we tend to overestimate the accuracy and completeness of our knowledge. We think we have a clear, well-supported view of an investment opportunity. This, in turn, can lead us to overestimate our ability to control or predict investment outcomes. We might think that because our thesis is right, we can steer our investments to success, even in the face of contradictory market forces. But the reality is, there are countless factors influencing market movements that are beyond any individual investor's control. Economic cycles, geopolitical events, technological disruptions, and so on. No matter how thorough our research or how strong our convictions, we simply can't control all the variables.
This is such an important point. It's easy to fall into the trap of thinking that if we just do enough research or analysis, we can consistently beat the market. But the illusion of control bias reminds us that there's always going to be a significant element of uncertainty and unpredictability in investing. It makes me think of something I read in the past about the difference between risk and uncertainty. Risk is quantifiable. We can measure it and to some degree manage it. But uncertainty is inherently unknowable. It's the realm of unknown unknowns, the factors we can't see coming or plan for. The illusion of control bias seems to make us confuse risk and uncertainty. We think we can research and analyze our way to total certainty, when in reality, all investing involves some degree of irreducible uncertainty.
I love how you've connected this risk and uncertainty.
One key strategy is to focus on process over outcomes. Develop a systematic, disciplined approach to investing that's grounded in your long-term goals and risk tolerance. Then stick to that process regardless of short-term market movements. This could include regular practices like portfolio rebalancing, performance reviews, and staying within predefined asset allocation ranges. By committing to a structured process, you're less likely to get caught up in the momentary illusion that you can control or outguess the market. Another helpful practice is keeping an investment journal where you record not just what decisions you made, but why you made them. What was your thought process? What evidence were you relying on? What assumptions were you making? Periodically reviewing this decision-making record can help you spot patterns of biased or overconfident thinking. And finally, cultivate a habit of considering alternative scenarios. For any investment thesis, ask yourself, what could I be wrong about? What disconfirming evidence am I not seeing? What plausible scenarios could unfold that would undermine my outlook? This kind of pre-mortem analysis can help pierce the illusion of control and prepare you for a wider range of contingencies.
Those are fantastic suggestions. I especially like the concept of pre-mortem analysis, proactively imagining how an investment could go wrong before committing to it. It's a great way to stress test our assumptions and make sure we're not overestimating our ability to predict or control outcomes. And the investment journal idea really resonates with me as well. By documenting our decision-making process, we can gain a more objective view of our own strengths and weaknesses and start to recognize patterns of biased thinking.
These are all such valuable insights and practical tips. As we've explored in this session, the illusion of control bias can really trip us up as investors in modern financial markets. This discussion reminds me of fast versus slow thinking, System 1 and System 2. Could you give us a quick overview of Kahneman's framework and how it relates to the investing biases we've been exploring?
Absolutely. Kahneman's book, Thinking Fast and Slow, really brought the concept of dual process theory into the mainstream. As you mentioned, he breaks down our thinking patterns into two systems. System 1 is our fast, automatic, intuitive thinking mode. It's always running in the background, processing information quickly and effortlessly. This is the system we use for tasks like recognizing a friend's face or answering a simple math problem like 2 plus 2. System 2, on the other hand, is our slower, more deliberate and effortful thinking mode. We engage System 2 for complex mental tasks that require focus and concentration, like solving a challenging equation or analyzing a dense legal document. The key insight is that while System 1 is incredibly efficient, it's also prone to systematic errors and biases. Mental shortcuts like anchoring, confirmation bias, and the illusion of control are all examples of System 1's tendencies leading us astray.
So, in an investing context, our System 1 thinking might latch onto a stock's previous high price as an anchor or cause us to overestimate our ability to pick winning investments, right? Meanwhile, it takes deliberate effort and engagement of our System 2 to slow down, analyze data objectively, consider alternate viewpoints, and regulate the snap judgments of System 1. It seems like a lot of the strategies we've discussed for countering investing biases, things like keeping a decision journal, seeking contrary opinions, and using systematic review processes, are essentially ways of making sure we're appropriately engaging System 2 to balance out the biases of System 1.
That's a great synthesis. Let's walk through a concrete example of how an investor might use System 2 thinking to overcome a System 1 bias in a real-world scenario.
Let's look at a case of anchoring bias. Suppose an investor bought a stock at $50 per share, but the price has since dropped to $30 on news of declining sales. The investor's System 1 is likely to fixate on that $50 purchase price as an anchor, making it feel like selling at $30 would be taking a painful loss. This could lead to the irrational decision to hold the stock, waiting for it to rebound to the original price. To engage System 2, the investor would need to step back and analyze the situation objectively. Are there fundamental reasons to believe the company's prospects will improve and the stock will recover? Or is the investor falling prey to the sunk cost fallacy, throwing good money after bad? By consciously shifting into System 2 mode, reviewing the data, considering alternative perspectives, and making a deliberate decision based on current realities rather than past anchors, the investor can hopefully avoid a costly mistake.
It strikes me that this ties back to goals-based investing. By having clearly defined long-term investment goals and a systematic plan for achieving them, we give our System 2 a framework for evaluating decisions. Instead of getting swayed by in-the-moment System 1 reactions, we can ask ourselves, does this choice align with my long-term objectives and established investing process? If not, it's a sign we need to slow down and think things through more carefully.
I think that's such an important insight. Having that goals-based framework is almost like a protective scaffolding for our System 2 thinking, a guide rail to keep us on track when the mental shortcuts of System 1 might lead us astray. What's one key takeaway you'd want to leave our listeners with when it comes to using Kahneman's framework to make better investing decisions?
The main thing is to cultivate awareness. We can't completely shut off our System 1 mental shortcuts. They're too deeply ingrained. But by understanding how they work and recognizing situations where they might lead us astray, we can deal with it and proactively choose System 2.
Those are great points about how anchoring bias can lead us astray as investors. It's not just about individual stocks either, and anchoring can impact things like our retirement planning and overall market expectations too.
Retirement planning is a big one. Too many people anchor to age 65 as their default retirement age without carefully considering their actual timeline and needs. Another is focusing too much on round number price points, like when a stock drops from, say, $110 to $90. There's no fundamental reason a $100 stock is worth more than a $90 one. But psychologically, crossing that round number threshold can make the loss feel more painful than it should. Anchoring also commonly appears with inherited investments. An heir receiving stocks from a deceased relative often anchors to the value or strategy those investments had for their relative, without objectively assessing if they still make sense for their own goals and timeline.
Those are powerful examples. It seems a key theme here is learning to look past surface level markers and focus on underlying realities instead. I'm reminded of our previous discussion on having an investment process and philosophy as a protective scaffolding for our thinking. Having clear goals and a systematic approach provides a framework to evaluate decisions more objectively. Instead of reacting based on anchors, we can ask, does holding or selling this investment align with my long term plan? What would my process suggest is the rational move here?
That's a great connection. Anchoring shows how easily our judgment can be swayed by initial impressions in the absence of a solid foundation. By grounding our decisions in well-defined goals and an evidence-based process, we give ourselves a sturdier basis for tuning out irrelevant anchors and focusing on what truly matters to our individual needs as investors. It's not that we'll never be influenced by anchors. As we've discussed, these mental shortcuts are deeply ingrained. But by building our investing approach on a solid base of clear goals, objective criteria, and deliberate systems, we can hopefully recognize and counter anchoring's impact when it appears.
Well said. Any final thoughts on how we can start putting a more anchor resistant approach into practice?
I think the key is cultivating awareness and humility, simply recognizing that we're all susceptible to anchoring and that our initial take on an investment may be heavily influenced by arbitrary reference points is an important first step. When making a decision, ask yourself, what anchors might be coloring my perception here? What story might I be telling about this investment that goes beyond the objective facts? From there, slow down and engage your analytical System 2 thinking. Consciously assess fundamentals, challenge assumptions, invert the situation, and consider alternate views. Create space between knee-jerk System 1 reactions shaped by anchors and careful, goal-focused decisions. We may never be fully free of anchoring's pull, but by understanding how it works, spotting it in action, and deliberately countering it with reasoned analysis, we can hopefully limit its influence on our financial choices.
Let's discuss another cognitive trap that's become particularly prevalent in our digital age: confirmation bias. Could you share some insights on how the rise of social media and algorithmic feeds might be amplifying confirmation bias for investors today?
Certainly. Confirmation bias is our tendency to seek out, interpret, and remember information that confirms our existing beliefs while dismissing evidence that contradicts them. In investing, this often manifests as 1. Following only social media accounts or news sources that align with our market views. 2. Interpreting positive news as validation while dismissing negative signals. 3. Selectively remembering information that supports our positions. The digital age has dramatically increased our exposure to this bias. Algorithmic feeds on social media platforms are designed to show us more of what we already engage with. An investor who believes in a particular stock and interacts with bullish posts will be served more content affirming that view, creating an echo chamber. Consider an investor who's heavily allocated to tech stocks. They might follow investing forums focused on hyping tech companies, seek out analysis only from tech bulls, and dismiss concerns around valuations or regulation as temporary noise. Fixating on confirming information can blind them to critical shifts in fundamentals or market sentiment.
So in a sense, the digital tools intended to give us more information can actually narrow our perspective if we're not careful. That's concerning, especially since I imagine many investors are unaware of how their feeds might be reinforcing existing beliefs. What would be a good way for an investor to check if they might be falling prey to confirmation bias? Are there any practical steps to counteract it?
One simple check is to ask yourself, what information would prove my investment thesis wrong? If you struggle to think of anything or find yourself dismissing contrary evidence offhand, that's a red flag. You may be in the grips of confirmation bias. To counter it, actively seek out opposing viewpoints from credible sources. If you're bullish on a stock, read a well-reasoned bearish take. Build a circle of fellow investors who think differently from you. Aim to construct steelman arguments for positions you disagree with. Confirmation bias thrives on lazy, habitual thinking. By intentionally pursuing disconfirming information and pressure testing your beliefs, you can kick your mind into a more rational, objective gear. It's not easy. our brains prefer the comfort of confirmation. But the more you practice considering alternate views, the easier it becomes.
Those are great tips. It takes real mental discipline to purposely engage with opposing views. But as you point out, it's essential for balanced decision making.
For me, I suspect I give more weight to news and analysis that aligns with my generally optimistic view of markets. I gravitate towards content emphasizing the benefits of staying invested for the long term, which I do believe is important, but it can make me prone to downplaying shorter-term risks. Your point about seeking out credible contrarian views is well taken. I could probably do more to include some thoughtful bearish voices in my media diet as a balance to my innate optimism. Not to sway my long-term strategy necessarily, but to test my assumptions and ensure I'm seeing the full picture. It also underscores the importance of having a clear investing process and philosophy in place, as we've discussed. By grounding decisions in predetermined criteria and systems, I suspect we can reduce the pull of both confirmation bias and heat-of-the-moment emotions.
I think that's a key insight. While we can never completely eliminate our biases, we can hopefully constrain their impact by anchoring our choices in explicit investing principles and processes. Any final thoughts on how confirmation bias connects to the other behavioral traps we've explored?
Confirmation bias often works in tandem with the other biases we've discussed to create even more stubborn blind spots. For instance, an investor might anchor to a past price peak, then selectively interpret information to confirm their belief that the stock will inevitably return to those highs. Or they may have a strong status quo bias towards a legacy position, seeking out only positive news while ignoring critical business challenges. By pursuing confirming information, investors can craft convenient narratives that justify anchored expectations, discomfort with change, and overconfidence in their predictions of outcomes.
Great points on how confirmation bias can amplify the dangers of anchoring and status quo bias. Next, I want to explore the inertia of the status quo in more depth. Could you walk us through how status quo bias manifests in investing and why it can be such a stubborn cognitive trap?
Absolutely. At its core, status quo bias is our natural human preference for the current state of affairs. We tend to view change as risky and uncomfortable, even when it's clearly necessary. In investing, this often plays out in three common ways. 1. Inherited investments. Imagine an investor who inherits a portfolio of blue-chip stocks from a parent. Even if those stocks no longer align with their financial goals, the investor may resist selling them due to the emotional attachment and sense of continuing a legacy. 2. Legacy positions. Consider an executive who's built up a large position in their employer's stock through years of compensation. Despite the risks of concentration, they may struggle to diversify because that stock feels comfortable and familiar. 3. Outdated strategies. Picture an investor who found success with a particular strategy, like buying dips in tech stocks. When market conditions change, rendering that approach less effective, the investor may find it painfully difficult to adapt and explore new tactics. In each case, the gravitational pull of the status quo creates a powerful emotional barrier to making rational, necessary changes.
Those examples really bring the concept to life. I can easily imagine falling into those traps myself. It's almost like our brains are wired to resist change, even when logically we know it's the right move. I'm curious, are there any common signs that status quo bias might be influencing an investor's decisions? What should we watch out for in ourselves?
One telltale sign is a knee-jerk negative reaction to any suggestion of change. If your advisor recommends reallocating your portfolio and your immediate response is defensive or dismissive, that's a red flag. Another clue is catching yourself rationalizing the current state of affairs with phrases like, "If it ain't broke, don't fix it," or "This has always worked for me." While there's certainly wisdom in not chasing every new fad, reflexively clinging to the status quo can blind us to genuine improvements. It's also worth noting that status quo bias rarely acts alone. It often works hand in hand with other biases like anchoring and confirmation bias to create even deeper resistance to change. For example, an investor anchored to the peak price of a stock may selectively seek out bullish information to confirm their belief that the stock will rebound. The comfort of that mental narrative can supercharge the pull of the status quo, causing the investor to hold a losing position far longer than rational analysis would justify.
This is such an important point. Biases rarely operate in isolation. They often combine and compound in ways that can lead us deeply astray if we're not vigilant. I know we've covered a lot of ground today. As we begin to wrap up, what's one key insight you'll take away from this discussion of the status quo bias and its investing impact?
For me, the key takeaway is the importance of proactively challenging the status quo in my portfolio. It's not enough to make a plan and put it on autopilot. I need to be intentional about regularly pressure testing my investments against changing market conditions and my evolving goals. One concrete step I'm going to take is adding a status quo check to my annual portfolio review. I'll explicitly ask myself questions like, are my current investment selections still the best vehicles for my financial objectives? Have I been ignoring important changes in the economic or corporate environment? Am I holding any positions simply because they're familiar or emotionally significant? By making this kind of critical examination a systematic part of my process, I'm hoping to create a safeguard against letting status quo bias gradually pull my portfolio off track.
I think that's a wise approach. Designing our investment processes to counter these stubborn biases is an ongoing battle, but one that's worth fighting. There's another related cognitive trap that often compounds these effects: hindsight bias, or the "I knew it all along" fallacy. Could you unpack this bias for us and explain how it manifests in investing?
Certainly. Hindsight bias is our tendency to believe that past events were more predictable than they actually were. It's easy to look back at a market crash or a successful investment and feel like the outcome was obvious in advance, even if we had no way of knowing at the time. This bias often appears in a few common ways. 1. After a market downturn, many investors will claim they saw it coming, even if they took no defensive action beforehand. 2. When an investment performs well, we're quick to attribute that success to our own skill and foresight, rather than acknowledging the role of luck or broader market conditions. 3. We may think we knew a particular stock or asset class would be a winner, even though we never acted on that supposed knowledge. The danger here is that hindsight bias can fuel overconfidence in our ability to predict future market movements. If we believe we successfully called past events, we may be more inclined to think we have a crystal ball for future returns.
It's scary how easily we can convince ourselves that we saw something coming. I've definitely caught myself thinking, I knew that stock would take off, when in reality, I had no special insight. So if hindsight bias gives us a false sense of predictive powers, how does that translate into counterproductive investing behaviors? What are some of the biggest risks to watch out for?
One common pitfall is that overconfidence can lead to excessive trading. If an investor believes they can consistently anticipate market movements, they may be tempted to time the market by jumping in and out of positions frequently. But research has shown that higher trading activity often leads to lower returns, in part because it's so difficult to get the timing right consistently. Another risk is taking on too much concentration in an effort to capitalize on that perceived predictive edge. An investor who thinks they have a foolproof read on a particular stock or sector may be inclined to make oversized bets, neglecting the importance of diversification. Hindsight bias can also cause us to underestimate risk in our portfolios. In hindsight, successful investments look safer and more obvious than they really were. This can lead us to take on more risk than is appropriate for our goals and tolerance, because we assume we'll be able to navigate any temporary downturn.
Those are sobering points. It's all too easy to let the false confidence of hindsight push us towards behaviors that can undermine our long-term investing success.
Absolutely. As I'm listening, I'm realizing how seductive that feeling of "I knew it" can be. It's a powerful emotional reward that can easily override our rational thinking. But I wonder, don't some investors and fund managers have real predictive skill that goes beyond just hindsight bias? How can we tell the difference between luck and genuine foresight?
That's a great question, and it gets at a perennial debate in investing. There are certainly investors out there who have put up impressive track records over time. But the challenge is untangling skill from luck, especially over shorter periods. Even the most skilled investor will have lucky streaks and rough patches. In the short run, it's very difficult to differentiate foresight from fortune. That's why it's so important to look at long-term performance across multiple market cycles. There are also some important questions to ask when evaluating an investor's supposed prescience. Are their successful predictions documented in advance, or are we only hearing about them after the fact? Hindsight bias and selective memory can make past predictions seem more accurate than they really were. Do they have a clear, understandable investment process, or are they relying on instinct and gut feel? A consistent, thoughtful approach is more likely to yield lasting success than hot tips and hunches. How do they handle being wrong? Every investor will make bad calls sometimes. The key is whether they acknowledge those mistakes, learn from them, and adapt their process accordingly. Ultimately, the most successful investors tend to be the ones who focus on controlling what they can. Things like asset allocation, diversification, and discipline, rather than claiming some special power of prophecy.
I think that's such a crucial distinction. There are dangers of relying too heavily on hindsight. It's easy to fall into the trap of thinking we have more control or predictive power than we really do. Next, I'm wondering if you could expand on this idea of control bias and how it plays out in different ways for investors. What are some of the most common manifestations you see?
Control bias is a pervasive issue that can lead investors to make suboptimal decisions in a few key ways. One common pattern is engaging in frequent trading based on the belief that active management will consistently beat the market. Investors may feel a false sense of control over outcomes by constantly tweaking their portfolios. But in reality, excessive trading often leads to higher costs and lower returns compared to a more patient, disciplined approach. We also see control bias crop up in market timing attempts. It's tempting to think we can outsmart other investors by anticipating market peaks and troughs, but the evidence shows that even professional fund managers struggle to time the market with any consistency. More often than not, these efforts can lead to missed opportunities when investors are sitting on the sidelines. Another manifestation is maintaining highly concentrated positions in a small number of familiar stocks. Investors may feel a sense of control by investing in companies they know well, but this can lead to dangerous lack of diversification, amplifying the portfolio's risk profile.
I can definitely relate to some of those behaviors. I know I've been guilty of checking my portfolio too frequently and getting tempted to make changes based on short-term movements. It's like I trick myself into thinking I can outmaneuver the market. But if I'm understanding correctly, a lot of the factors that drive broader market returns are ultimately beyond any individual investor's control, right? Things like economic cycles, global events, changing technologies. It seems almost impossible to anticipate how all of those forces will play out consistently.
That's exactly right. While we can certainly analyze market and economic trends, so much of what moves markets is inherently unpredictable. Geopolitical events, natural disasters, disruptive innovation, these are just a few examples of the myriad complex factors that drive asset prices. As investors, it's crucial to focus on the areas where we can exert meaningful control, like asset allocation, diversification, and maintaining a long-term perspective. But we have to be humble about our ability to influence outcomes. There's a great quote from Howard Marks on this. He said, "You can't control the environment. The only thing you can control is your reaction to the environment." I think that really encapsulates the challenge of calibrating our perceptions of control in an uncertain and uncontrollable market.
I love that quote. It's such an important reminder to focus our energy where it can make the most impact. We may not be able to control market outcomes, but we can absolutely control our own investment processes and behaviors.
That makes a lot of sense conceptually, but I'm curious how we can translate that into action. What are some practical steps investors can take to rein in those control bias tendencies? I imagine things like having a clear investment plan and sticking to it would be one key element. But what other guardrails can we put in place to make sure we're not being overly influenced by that illusion of control?
Developing a systematic investment process is definitely a great starting point. Having clear, predefined rules around things like asset allocation, rebalancing, and position sizing can help prevent heat of the moment decisions driven by control bias. Another key is to be intentional about your information diet and monitoring habits. If you're checking portfolio values multiple times a day, that constant feedback loop can fuel emotional decision making. Consider setting boundaries around how frequently you review your investments and be selective about the sources of information you consume. Working with a professional advisor can also be very beneficial. A skilled advisor can provide an objective perspective and help identify when control bias might be pushing you off track. They can serve as a rational sounding board and help enforce disciplined investing habits. Ultimately, it's about striking a balance between staying engaged with your investments and recognizing the limits of your control. Stay focused on the big picture, trust in your long-term plan, and don't let the short-term noise tempt you into overactive management.
Those are fantastic insights. It really highlights how being aware of our behavioral tendencies is only the first step. The real challenge is developing practical strategies to translate that awareness into action. I think the key takeaway is that while we can't control the markets, we can absolutely control our investment processes.
Absolutely. It's one thing to recognize biases intellectually, but it's another to have systematic processes in place to prevent them from derailing our investment decisions. One framework I like to recommend is what I call the 3Ds: document, diversify, and delegate. Documenting your investment thesis before making a decision can help slow down your thinking and engage that deliberate system 2 we discussed earlier. Capturing your rationale in writing makes it easier to spot flaws or inconsistencies that might be driven by behavioral biases. Diversification is another key safeguard. By spreading investments across a range of asset classes, sectors, and geographies, we limit the impact of any single decision. Even if a specific holding is influenced by a mental shortcut, the overall portfolio is insulated from outsized harm. Finally, consider delegating some investment decisions to objective third parties. Whether that's following a rules-based model, investing in index funds, or working with a financial advisor, outsourcing can help protect against our own behavioral blind spots.
I like the simple framework of the 3Ds. That makes it easier to remember and apply. On the delegation point, I can see how taking myself out of the equation for some decisions could lead to better outcomes. But I'm wondering, how do I evaluate if a financial advisor or investment approach is truly objective and grounded in evidence? It seems like there are a lot of providers out there, each claiming to have the best strategy. What should I look for to assess if their process is actually countering behavioral biases effectively?
That's a great question and an important consideration. When evaluating investment providers or strategies, a few key things to look for are: 1. A clear, evidence-based investment philosophy. The approach should be grounded in academic research, not just anecdotal gut feelings or past performance. 2. Systematic, rules-based processes. There should be predefined criteria for making investment decisions, not ad hoc judgment calls. 3. Transparent reporting and communication. You should have a clear understanding of how decisions are made and visibility into the drivers of portfolio performance. 4. Acknowledgement of uncertainty and risk. Watch out for providers who claim to have a secret formula or to consistently beat the market. Trustworthy advisors acknowledge the inherent uncertainty of investing. Ultimately, you want to work with partners who have a demonstrable commitment to discipline, consistency, and objectivity in their approach. Those foundational elements can go a long way in countering the behavioral pitfalls we've been discussing.
This has been such an enlightening discussion. As we wrap up, I think one of the key takeaways is that while we can't completely eliminate the influence of mental shortcuts, we can absolutely take proactive steps to manage their impact. By increasing our self-awareness, slowing down our decision-making, seeking out diverse perspectives, and implementing systematic investment processes, we can meaningfully improve our chances of overcoming bias and achieving long-term financial success.
Well said. I think it's important to remember that this is an ongoing process. Our behavioral tendencies are deeply ingrained, so it takes consistent effort and vigilance to keep them in check. But the payoff is worth it. By developing a more rational, evidence based approach to investing, we can increase our resilience in the face of market volatility and improve our likelihood of achieving our long term financial goals. It's really about aligning our investment process with our values and objectives and having the discipline to maintain that alignment even when our mental shortcuts try to pull us off course. It's a lifelong journey, but one that's incredibly rewarding.
I couldn't agree more. Thank you both for sharing your insights and strategies with us today. To our listeners, we hope this discussion has given you some valuable tools to reflect on your own investment approach and take actionable steps toward more rational, successful investing. Be sure to check out the show notes for links to additional resources on this topic. Thanks for joining us today, and we'll see you next time as we continue our exploration of the fascinating world of behavioral finance and evidence based investing.